Happy Friday. Welcome to The Open. Let's get to the big stories we're bringing you from our newsroom. Canadian retail sales rose 1.3% in November versus the previous month. According to Statistics Canada, the increase was led by gains at food and beverage retailers. Core sales climbed 1.6%. However, an advance estimate from StatsCan suggests that overall retail activity dipped in December. U.S. President Donald Trump has disinvited the Prime Minister, Mr. Carney, from his so-called Board of Peace. It's a U.S.-led effort to oversee reconstruction of Gaza after years of conflict and attacks by Israel. Trump made the announcement in a Truth Social post. The invitation withdrawal comes days after Carney delivered a speech at the World Economic Forum, warning against coercive tactics by the world's great powers. China's ambassador to Canada says allowing a limited number of Chinese electric vehicles into the country could lead to new auto jobs and cheaper cars. The comments come as Ottawa faces criticism over the deal signed by Mr. Carney and China's Xi Jinping. Ontario Premier Doug Ford has urged Canadians to boycott all Chinese EVs. Ford, the Premier, says the vehicles put thousands of auto sector jobs at risk. And there's a look at U.S. futures. They are pointing to a soft open this morning. There was something of a relief rally after Mr. Trump backed down from his threat to take over Greenland by force, potentially. But U.S. stocks could well be down on the week. And let's check out the TSX. Can't quite get back up to its record highs, but you can see it ended yesterday above that 33,000 psychological mark. Let's check out oil. As usual, there's cross currents and winds in all directions, moving oil, but you can see it has topped $61 in early trading. There's a receding threat now, it seems, of U.S. tariffs over Greenland, and that removes one threat to global growth. And finally, let's have a look at gold. And gold pushing for a new record today. At this rate, doesn't look like $5,000 US is far off. Let's check out our Canadian dollar, our currency, and it's strengthening again against the US dollar, at this rate, moving towards 73 cents US. And finally, Bitcoin, the world's biggest cryptocurrency. And you can see, it's slightly up to date, but way off its record highs of last fall. The Bank of Canada has another print to digest before next week's announcement on interest rate policy. Canada's November retail sales rose 1.3%, although it looks as though December saw a downturn. That's according to early estimates. Let's get more from Earl Davis, head of fixed income and money markets at BMO Global Asset Management. Earl, always great to see you. What is, if you could generalize, what is the picture for the Canadian consumer right now? We know that confidence is not that high.
That's true. But first of all, good morning, Andy. Pleasure to be here as always. For the Canadian consumer, well, let's start with the number and the retail sales. It basically beat expectations, came in largely as expectations, but beat it in regards to the headline number, especially on the core. So when you take out autos and stuff, 1.7 versus 1 expected looks good from a headline perspective, but there's a lot of noise in that number, especially from BC strikes and, beverages and beer sales were actually the driver of that. So you have to discount the number a bit, which points to the advanced number for next month, which is minus 0.5. So it's pointing to a weaker consumer, which isn't surprising in this environment, given the uncertainty, global uncertainty, economic uncertainty. So it does point to a weaker consumer going forward for the balance of the year.
And Does that cut? Is that a big deal for the Bank of Canada as they assess interest rates, consumer behaviour, or what are the crucial metrics they look at? Labour, obviously,
it's
is
an
important.
metric, but so let's stick with this. Does it impact them right now? No, we believe the Bank of Canada will be on hold next week. This number doesn't change anything. And remember, the advanced number is an advanced number. It's an indication and could change towards as we get to the real number. So your other question, what are the important metrics for the Bank of Canada? There's two important metrics in what I'd call top tier. The first one's inflation. And inflation still remains sticky. It's still above their target band of, like, let's call it midpoint of 2%. So that's an important consideration. And one of the reasons why they'll remain on hold, especially when you look at the actual cost of goods, you look at commodities, you look at all the things that will impact inflation in the future, and they don't look like it's going down. The only thing that's negative from an inflationary perspective are rents. But again, the influence of that on the overall inflation number is limited. The second most important number that they look at is employment. And they look at employment because that reflects the consumer's ability to spend, whether it be on mortgages, rent, and most especially goods, consumer goods. And as you've seen, we've been getting surprisingly strong numbers on unemployment. The unemployment rate's still fairly elevated, but it's not as elevated as the market was expected. So again, another reason to be on hold. Our team's, longer term outlook, we do expect eases this year. We expect between 1 and 2 eases by the end of the year. And that's still driven by the uncertainty surrounding USMCA, the lack of business investment because of that uncertainty. We feel that'll have a drag or negative impact on Canadian growth.
The interesting thing, obviously, is what point does Bank of Canada rate policy become aggressively stimulative for the economy? If they do cut it again, is it fair to say that they're trying to rev up the economy?
Yes. So that brings in the third most important number, which is growth and GDP. And right now, growth is positive. So when do they become extra stimulative? They would argue they're kind of neutral to stimulative now, minorly. But when do they become more so stimulative? If growth really takes a downturn. And that's why I point to the first tier numbers. Employment's usually a leading indicator of growth. Less people employed, there's less production, and it's a leading indicator of consumer spending and the ability to afford rent. So until you see growth come down in those other two numbers, they're all right to be on hold. The reason why we believe there'll be an ease towards the end of the year, that extended uncertainty from USMCA, you might need a little extra boost in the economy. And although interest rates won't have a dramatic impact, especially it's only 1 or 2 basis point eases, it does in fact impact the psyche of the consumer. And that's a very important aspect as well. And I'll bring up one more thing that the Bank of Canada pays a lot of attention to, and that's the business survey. Business survey outlook just came out last week, and that points to what business owners are looking to do going forward. And that's where that uncertainty around USMCA is being reflected. So if you see a downturn in that, further downturn in that will accelerate the stimulation that the Bank of Canada will put into the market through interest rates.
Obviously, 10-year bond yields in Canada, for example, are a powerful driver of mortgages and the cost of businesses borrowing. That yield has been pretty flat for more than a year ago. No big swings.
Yeah, it's been surprisingly flat. And part of the reason for that is one of the largest influences on the 10-year rate that you're showing now is actually the U.S. 10-year rate. And ever since Bessett in the U.S. has said, the Treasury's there to support yields if we need to, as well as the tariff income has reduced the amount of issuance in 10-year bonds in the U.S. So that has kept 10-year bonds relatively flat for the past year. And that's actually one of our underlying sort of investment premises. We believe 10-year yields will be within the range of the 2025 yield. And we're right at the midpoint right now, or just below it. So there's nothing to do on interest rates in regards to sovereign bonds, 10-year bonds right now. But if we do get a spike higher in yields, like it looked like we could have earlier this week before President Trump backed down from more aggression towards Greenland, then we become better buyers. The good thing about stable 10-year rates, it makes investing in corporate bonds increasingly important. And the reason why it makes that increasingly important is because you want a stable coupon yield. And that's what you get from corporate bonds. You get that 10-year rate that you saw, the 343 in Canada, or 425 in the US, and you add in the corporate spread, and you get even more interest, and it's above inflation, which is why we are overweight corporate bonds and like buying corporate bonds on any sort of volatility or backup. It's almost the equivalent reflection of equity markets in a sense.
Earl, thank you very much for joining us. Earl Davis, Head of Fixed Income and Money Markets at BMO Global Asset Management. Coming up, in an effort to win back Canadians that have stayed away from Sin City, some Las Vegas hotels are accepting the Canadian dollar at par. We'll have more next. Canada is the biggest international visitor market for Las Vegas, but there has been a significant decline in Canadian travel. In an effort to attract us Canadians back to Sin City, some hotels in Las Vegas are offering to take Canadian money at par. We are joined by CTV's Scott Hurst. Scott, thanks very much indeed. I have fond memories many years ago of playing craps at the Golden Nugget. And it looks like the Las Vegas casinos are hungry for business with Canadians.
Andrew, good morning. We all know for many Canadians, Las Vegas is definitely a destination. Of course, this time of year, there's the climate. It is much warmer, but also, as you pointed out, there are the gaming options and all the entertainment options. But for much of the past year, we've seen these travel numbers have been pretty consistent, that Canadians, not just Las Vegas, but have shunned a lot of travel to the United States. And now some U.S. hospitality chains are obviously looking to grab some headlines, at least north of the border, with promotional stunts to lure us back across the border. And at least one Sin City hotel chain is rolling the dice, gambling that Canadians will come back for a good deal. 3 hotels in Vegas are now accepting the Canadian dollar at par for select gaming, hotel, and drink services, with this promotion running through the summer, with the goal at least to remove the financial barriers for Canadians wanting to travel again. As we know, many Canadians have pointed to the weak loonie as a reason for not crossing the border, but also the political climate, as a new Abacus poll has shown. 1 in 4 Canadians, about a quarter of respondents to the survey, say they've avoided travel to the United States, Andrew, because of feelings towards U.S. President Donald Trump.
The latest numbers I've seen are for November, and apparently trips by Canadians to the U.S. and back were down 24% year over year.
Andrew, these numbers just out from Stats Canada for the month of November, and you're right, almost 24% decrease in overall trips returning from the United States for Canadians. And to break that down even further, between car trips and plane trips, return trips from the U.S. by car declined more than 28%. Those are often trips, of course, right across the border, often to those border states. And in November, return trips by Canadians by air was down more than 12%. But that doesn't mean Canadians aren't traveling. We've seen, at least anecdotally, a lot of Canadians have decided to travel across this country, keeping our tourism dollars in Canada, but also to many other places around the world, as these latest numbers from Stats Can also point out that Canadian resident return trips from overseas countries by air actually increased more than 14%. So it shows Canadians aren't just staying home. They are still traveling, just not wanting to go to the U.S. right now for the political climate and, of course, the dollar exchange.
Scott, thank you very much indeed. Scott Hurst of CTV News. A now shuttered theme park in Niagara Falls, Ontario, is reportedly once again warning the federal government that it'll be forced to kill dozens of beluga whales unless the government urgently approves a new request to move them to aquariums in the United States. Marineland has presented the plan to the fisheries minister after a proposal last year to send the whales to China was rejected. CTV's John Venavalu Rao has the latest.
The future of these belugas has long been uncertain, stuck in a shuttered theme park that closed 17 months ago. Now Marineland wants to ship them to the States and reportedly making backup plans to euthanize them if Ottawa says no.
I think it could very well be the best place for these animals to go. But I think it's so wrong that Marineland is holding the government hostage.
In what's being called an urgent rescue proposal, Marineland's 30 remaining belugas and 4 dolphins would reportedly be sent to aquariums in Orlando, Atlanta, Chicago, and Stonington, Connecticut. Marineland has said it can't afford to look after the whales and wants to sell the property. Last year, it pitched transferring them to an aquarium in China, but Ottawa denied that request.
You want to send them to a place where there's accountability. The original proposal to send the whales to China didn't address that. This new proposal does.
Some had hoped they could be moved to a proposed seaside sanctuary in Nova Scotia, but it has yet to raise the millions it needs to open. In a statement, the Fisheries Minister's office confirmed the minister was presented with new export permit applications and that the minister will review them expeditiously. 20 whales have died at Marineland since 2019, and experts say sending them to multiple aquariums in the U.S. is hardly a perfect solution.
It's going to break them up, so that's not great for family and relationship bonds between the animals.
And some would like to see assurances they won't be used for breeding, which is illegal in Canada. Still, the experts we talked to all think Ottawa will give the proposal the green light, given the options that remain. John Venavalu Rao, CTV News, Toronto.
Up next, what the sparring between the Prime Minister and the US President could mean for the forthcoming CUSMA trade negotiations. That speech by the Prime Minister in Davos earlier this week, in which he warned of the world's biggest nations adopting bullying policies, it's still spurring reaction. The U.S. Commerce Secretary, Howard Lutnick, in his own speech at the forum yesterday, talked about pointed remarks and what he described as whining from Canada. Let's get more from CTV's Mike LeCouture on what this could mean for trade negotiations.
Give me a break. They have the second best deal in the world. And all I got to do is listen to this guy whine and complain.
U.S. Commerce Secretary Howard Lutnick called the Prime Minister's speech in Davos political noise. Tuesday, Mark Carney urged middle powers to band together against more powerful countries that use economic coercion. Lutnick warned those words will be remembered during this summer's trade review.
They have USMCA, which means 85% of the Canadian economy comes into the United States for zero. And there he is complaining that he's going to go to China and improve it.
Canada's finance minister pushed back on those comments.
Prime Minister said a lot of things that people thought, and he had the courage to say it loud. I think Canadians have understood by now that diversification is key.
Meanwhile, the reverberations of Carney's message continue to be felt with other world leaders.
I think we have a lot of Europeans who are in this first camp of multilateralism, whereas the American administration is driving multipolarity. And we're trying to make these two things meet.
Australia's treasurer called the speech stunning, adding it makes a powerful point about the old world order being over.
So the job for us, the job for our Canadian friends, is to work out how we can shape all of this change in our own interests.
California governor and possible Democratic presidential contender Gavin Newsom also praised Carney at Davos for calling out the current state of the world, adding Americans need to do the same. Mike LeCouture, CTV News, Ottawa.
Let's have a quick look at the markets as we head towards the open on this, the final trading day of the week. We did see weakness in U.S. There's the Asian markets. Let's kick off with them. We did see weakness, though, in U.S. Futures this morning. There is the day's action in Asian stocks. The Nikkei holding in. There's been an extraordinary rise of in Japanese interest rates and China. This is interesting. We know that there's been this face-off between America and China over access to NVIDIA's powerful H200 AI chips. But apparently, Chinese officials, according to Bloomberg, have told the giant Chinese tech firms, yeah, you can prepare orders for NVIDIA's H200 AI chips. And let's move on to Europe. And you can see kind of lackluster numbers there for Europe. Of course, a sigh of relief in that part of the world that President Trump has dropped his threat to slap tariffs on Europe. And of course, the EU is backing down for now, suspending the planned counter tariffs on more than 90 billion euros worth of US goods. Let's have a look now at the US futures, just see how they're doing, because it has been a choppy week, as they put it. And you can see that US stocks look like they're going to have a slightly weaker open. The S&P 500, I'm not sure if we can pop up a 1-week chart. I'm showing it down about 1/5% this week, while Toronto is down a fraction of 1%. So there you have it, the S&P 500, according to our chart there, down about 0.5%. The NASDAQ, maybe we could pop up a 1-week chart for it as well. The NASDAQ composite down slightly this week. And at one point, this Greenland to and fro, there were fears that the U.S. market did slip into negative or at least zero returns for the year, wiping out all of its gains. So it's been a worrying few days for investors, but generally they seem now to be shaking off the jitters over the tariffs. Let's have a look at Clorox here, because it is getting bigger in hand sanitizers. It's buying the maker of Purell, the top brand, or among the top brands in sanitizers, in a multi-billion-dollar deal, more than $1 billion. And let's have a look at SLB, also known as Schlumberger, the giant oil sands company, getting a boost here. Look at that, up almost 2% and ahead 13% in the past year, which is interesting with oil prices so weak. SLB rising after the EPS beat and revenue increased globally. And let's have a very quick look here at Intel. Intel stocks set for a weaker open. Investors worried about lack of progress on the AI front. And we're going to have plenty more about Intel on the open coming up. Those opening bells are next. And there you have it, the opening bells on Wall Street and Bay Street. Over at the NASDAQ, its equipment share is doing the honors, ringing the bell. At the NYSE, it's Rhythm Capital ringing the opening bell. And at the TSX, Paragon Advanced Labs celebrating its listing on the TSX Venture Exchange. It's time for the first 50. And let's have a quick look at some stocks on the move. First, a look at the broad benchmarks, and you can see the NASDAQ now narrowly ahead, the S&P flat at the open of trading, the TSX higher. Some stocks of interest, Lululemon. I can see the late night TV hosts having fun with this. There's been criticism of their new line of pants, saying they're transparent. Lulu is apparently advising users to wear flesh-colored underwear if they don't want to be giving too much away. But I don't know, it sounds like it's a gift for comics. The punchlines will be coming fast. Bausch Health down. It sounds like trials for a liver disease, phase 3 trials for a liver disease were a disappointment. They, quote, did not meet expectations. And in fact, this treatment is designed to prevent brain dysfunction in patients with liver cirrhosis. They were looking to fix a condition where the liver can't remove toxins from the blood, and then they build up and impair brain function. And okay, well, let's keep it moving here. Let's get more on stocks on the move south of the border. We're joined by Jeff Morgan, Deputy Team Leader for the Bloomberg News Equities team. Thank you very much, Jeff, for joining us. Happy Friday. I'll see you down at Toronto Harbour for a polar dip tomorrow. Your game.
Oh, most certainly.
Yeah, anyway.
I can't wait. I can't wait to jump in that water.
Just for viewers elsewhere, I've seen a forecast of minus 24 for Toronto early tomorrow morning. Fortinet getting an upgrade at TD Cowen. Remind us what they do and what's TD saying, please.
Yes, that's right. Yeah, Fortinet is getting an upgrade at TD Cowen. This is a software or a security software company. And they're getting an upgrade today. So far, they are the top performing stock in the S&P 500, and they're definitely one of the stocks in the U.S. that is worth watching today, up as much as 6% in the pre-market session. Keep your eye on this one over the course of the session. What has happened here is TD Cowen has upgraded the stock and said that based on channel checks, this is where an analyst calls around and tries to get a sense of what the revenue is going to be when they do come out and report. Based on channel checks, TD Cowen is expecting that revenue and sales are going to be ahead of what Wall Street expects for the fourth quarter. Of course, software in general has been one area where there has been expectations that maybe artificial intelligence would come along and eat their lunch and maybe potentially offer some services that may compete against what they offer. In this case, that is not what TD Cowen is seeing, according to the analyst there. AI not eating security software, but enhancing it at this point. Price target set to $100 a share for Fortinet at TD. So one worth watching. Great big, 9% now in the regular trading session. This is a stock worth watching today.
Right. I think... Yeah, anyway, I was just thinking about our polar dip tomorrow. But in any case, Intel, investors not happy with that chip giant right now.
No, not happy whatsoever. This is the worst performing stock in the S&P 500 and definitely worth watching over the course of the day. So what has happened here? The company has said that it has used up most of what it had in its inventory in the fourth quarter and is running into some manufacturing problems and delivering additional chips. And so, Citi came out this morning, cut the price target on the stock to $48 a share from $50, and pointed to this problem with the manufacturing, saying that if the company had chips available, if the company had the production capacity to meet demand, sales would have actually been ahead of forecast, ahead of what the street was expecting, and that is not what we're seeing today. So the manufacturing problems, which the CEO also addressed on the call this morning, saying that they're not up to his standard and it's going to take, quote, time and resolve to fix, is really weighing on the shares. If you have a company that would love to sell its product but just can't make it, this is a kind of a problem. Wall Street largely negative on what we've seen so far today. The stock took another leg lower on those CEO comments. And as I mentioned, worst performing stock in the S&P 500 so far.
I just wanted to warn you, I'm probably only going to stay in the water about half an hour tomorrow. I'm going to take it easy because it will be quite cold.
It will be quite cold. Half an hour, I think, is pretty reasonable
it's probably
under the circumstances.
Enough. Jeff, thank you very much indeed. Jeff Morgan of Bloomberg. Coming up, gold keeps hitting record highs, but is it getting pricey? We'll get perspective after this. As of today, gold was up about 7% this week. It's been hitting record after record. Let's get more from Matt Kaser, president at FSA Valuation Service. Thanks very much indeed for joining us, Matt.
Thanks for having me.
You can see a bullish case for gold, but you wouldn't be putting massive amounts of money into it right now?
Yeah, I mean, listen, we don't do a lot of technical analysis. Our is kind of quant work with fundamentals. So, revenue growth, cash flow, return on invested capital, those are things that really drive our decision making. But I'm sure if I asked some of my colleagues that look at charts a little bit more, they would say, hey, these these are overdone. I mean, some of the numbers are just astounding, and it's really hard to recommend new money going into this. I think, if you own some of the stuff, you're probably playing with the house money at this point, so probably okay to hold on to them. And frankly, a lot of these golds don't look all that expensive on multiple basis, and the way we do our models, they don't look that crazy. It's just those darn stock prices, their stock charts, they're just up on an absolute stick. So I got some numbers. If you want to allow me to go into these details, I'm not sure if you want me to do that.
Give us one or two anyway, Matt. Thanks.
Yeah, okay. So one that we've really liked was Aura Minerals, and that's AUGO on NASDAQ. And it used to be a Canadian listed. I'm not sure why they decided to just go NASDAQ. But the return on capital is 20%, which is huge for a mining company. Revenue growth last quarter was 57%. So, I mean, that all looks great. The stock price for 1 year is up 454%. So, 454%, and you're recommending to buy this stock. Well, I mean, it's only trading at 15 times. So again, everything lines up. The fundamentals are good. I think gold's going higher just based on geopolitical tensions and central banks buying more gold. Even the stock itself doesn't look all that expensive. But 454% in 1 year kind of just makes me a little hesitant to say put new money here. But if you own it, I think you're okay.
And we were having trouble with the chart there, but that stock, up more than fivefold in the past year, or Aura Minerals. Lundin Gold, big player in Ecuador. They say they have a big potential copper play there as well. What are you attracted to this stock?
Yeah, so we've owned that one for quite a while too. I mean, similar numbers, maybe not quite as gaudy as Aura Minerals, but return on capital is 44%. We love that. And it's been climbing as well. The change or improvement in return on capital, we love. Revenue growth was 38% in the last quarter. The EV/EBITDA is 19. So, I mean, that's up there relative, I guess, to some other golds, but that's not outrageous either. And then again, the stock price is up 253% according to our data. And, 253% in 1 year is quite substantial. So, we're in the same boat here. Everything looks great. Again, if you own it, I think it's a great company. Hold it through I'm sure we're going to have some volatility. If you don't own it, just look for an opportunity, I would say, is probably the better way to go.
Can we switch over to chips? You reckon that the outlook looks strong there? We're hearing from a lot of those companies, hey, we can't keep up with demand.
Yeah, and I agree with that. I think, some of the projections for this year are astounding. It's not slowing down at all. There's, I don't know how you keep up this exponential growth on revenue, but they seem to be doing it. And the projections are not coming down. Everything's great there too, in terms of fundamentals. I would say in this case, the valuations are getting a little bit richer. We talked about with the gold, 15 times, 19 times. NVIDIA, we got 34 times. EV/EBITDA is our preferred one that we do, and we do some adjusting for accounting, but let's, not get too into the detail there. And then Broadcom's another one we love. It's 35 times, but the fundamentals are excellent for all of these companies. And the big four to me are NVIDIA, Broadcom, Taiwan Semi, and ASML. I would call those the core four. Not to be the Maple Leafs core four, but that's a good core four right there.
And finally, in healthcare, you would be a buyer, or you'd be interested in putting new money into Novo Nordisk?
Yeah, so healthcare, we're trying, everything's gold and AI, and where do we go next? And healthcare hasn't been all that great for the last few years. So there's got to be some opportunities there. So started looking, in fact, we've owned Novo Nordisk and suffered through some of this downside, but I think it's an excellent company. The financials have been really strong. They just got approval for the GLP-1 pill. for weight loss. That's new. That's the only one on the market that is approved in the pill form. So even their competition, Lilly, does not have an approval for their pill form for weight loss. So I think, given that it's pulled back and healthcare has been a little rough, if you're kind of looking for opportunities for stocks that have been down, this looks like a great opportunity to me.
Thank you very much, Matt. Really appreciate it. Matt Kaser there from FSA Valuation Service. Let's have a very quick look at Nova Gold here. Probably going to see a lot of this from companies developing mines. And they have announced that, they did announce that we're going to sell 20 million shares at $10 US a share, but they've since boosted that to 30 million. So it sounds like the ducks are quacking and this gold company is feeding them. Coming up, Intel under pressure. Investors not thrilled with that guidance. During a speech to the nation yesterday, the Prime Minister dismissed U.S. President Donald Trump's claim that Canada lives because of the United States. He said the country he's leading, quote, thrives because we are Canadian. Let's get more on this and the latest from the Liberal cabinet meeting in Quebec City. We're joined by CTV's Jeremy Chiron. Jeremy, thanks very much for giving us the time. So Prime Minister Carney not backing down here, even though he's ruffled the feathers of Trump, it seems.
Yeah, absolutely, Andy. Look, to your point, not backing down yesterday, responding directly to Donald Trump's criticism in Davos, saying that, Canada does not live because of the U.S., but rather Canada thrives because we're Canadian. Now, since that comment was made in the Prime Minister's speech yesterday, of course, late last night, President Trump taking to social media announcing that the Prime Minister's invite to the Board of Peace is being rescinded. So a lot of focus this morning here in Quebec City on reaction to that news and what it means for the relationship between Canada and the U.S. And what led to this, what the reasoning was. U.S. President Donald Trump didn't offer up any definitive reason for why the invite was being rescinded. Now, of course, we know that initially the Prime Minister had said he would be accepting the invite to sit on the Board of Peace, but then clarified that he would not be paying $1 billion fee that seemed to come with that seat. Then, of course, he made the speech in Davos that U.S. President Donald Trump did not like. And now here we are where, Prime Minister Carney's invite has been rescinded. The Prime Minister this morning on his way into cabinet did not stop to take questions from reporters here who were all very keen to get an answer as to, what has happened in the last 24 hours or in the last 12 hours, really, and why the invite was rescinded. Foreign Affairs Minister Anita Anand stopped briefly on her way in, didn't address specific questions about context for being disinvited, about whether or not the federal government knew ahead of time, the Prime Minister's office knew ahead of time that this was happening, or reasoning, but just clarified that Canada is still committed to peace, specifically looking for peace, of course, in the Middle East, that the future in Gaza has to be one that has no Hamas involvement, really just repositioning Canada's stance on that situation, but not answering direct questions about the rescinding of the invite. So, Andy, we'll be reporters here looking for certainly clarification on that today, while the official agenda today is all about sovereignty, trade, and security. Prime Minister and his cabinet are going to be hearing from speakers on those topics, which are, very apropos right now with everything, of course, unfolding in the world right now.
For sure. Thank you very much indeed, Jeremy. Really appreciate it. Jeremy Chiron, our colleague at CTV News. Now, Intel beat in its fourth quarter, but shares are under pressure after the company provided an outlook that disappointed some investors. We're joined by Matthew Bryson, Managing Director of Equity Research covering enterprise hardware at Wedbush. Thanks very much indeed.
Thanks so much for having me.
You have a neutral on the stock. You say that we didn't hear that much new from Intel, but tell us what were the main new points that the company produced?
Yeah, so Intel last quarter, they told us that they were going to be more constrained in Q1, that they just weren't going to be able to ship out of inventory. So revenues are going to be down. When revenues go down, that has an impact on gross margins, and that's what played out. If there was anything new, it was really, in my mind, that there's this opportunity in advanced packaging that might come about in 2027. It might be more meaningful than had previously been thought. But I think they told you pretty much what they said they were going to tell you last quarter.
So it sounds like they just can't keep up with orders. Is that right?
Yeah, no. So that's their problem. They don't have enough capacity. In particular, you're seeing a ton of demand from large customers for server compute, and Intel can't produce enough chips, and they've been shipping out of inventory. So satisfying customer demand with already produced product, and they just don't have any more.
And who makes the product that they sell? Is it manufactured by Taiwan Semi or somebody?
No, in Intel's case, it's coming out of their own fabs on the server side for the most part. So they are constrained by their own manufacturing capacity.
Now, your thesis, I think, if I got it right, is we've seen disappointment today because Intel had this big run-up prior to these numbers. Maybe we can put up a one-year chart again.
I mean, that's exactly it. So I think there was this hope that as Intel gets 18A up, so they start running chips on their own facilities, and instead of having to buy as much content from TSM, that as that node becomes more competitive with what's out there from TSM, that you start seeing margins on those new products begin to look like old Intel margins when they were doing, 60, even 70% gross margins on some products. And I think it's just too early.
Obviously, the perception has been that they're at risk of becoming an also ran in the AI chip out market. What are your thoughts on that?
I think that they are already an also ran. Now, having said that, when you look at what AI is going to drive, right, it's driving more demand for traditional compute. So they still benefit there. That's, in fact, why they have a shortage of server compute right now. And at the device level, it drives demand for more intelligent PCs, smartphones, what have you. And I think they have opportunities there. So I think they benefit from AI. But I think for them to actually be a player in terms of supporting AI, competing with the likes of NVIDIA, that's going to take a whole lot of development work. And we're a long ways away from anything happening on that kind of set of products.
What would make you fall in love with Intel stock or get you switching to a buy?
It's really seeing gross margin improvement and competitive improvement with their new sets of products. So, it's Panther Lake is their first product out on the PC side, but some of the new server products as well, seeing kind of continued trajectory higher in gross margins, which would suggest that yes, they're finally catching back up to TSM, but we're at the start of the journey, and you just can't see it in numbers yet.
Thank you very much, Matthew. Really appreciate it. Matthew Bryson, Managing Director of Equity Research, covering enterprise hardware at Wedbush. Up next, we're looking at who could be in the next group of AI winners. We'll be right back with John Ehrlichman. So we've seen a big run-up in AI stocks, particularly the chip suppliers. Some investors are betting the next big winners will be traditional companies that are rapidly adopting AI. BNN Bloomberg contributor John Ehrlichman has a new story on our website. On that topic, John hosts Ticker Take on YouTube. He joins us now. John, walk us through the thesis here, please.
Well,
Andy, obviously, a lot of people are trying to figure out the AI impacts. And earlier this week, you and I were talking about how that can negatively impact companies. Software has been a great example of individual stocks being decimated by this concern that AI is going to impact or disrupt their business. However, now that we have seen that impact, and to your earlier point, the big run-up in a lot of the AI suppliers, there's this big question about whether or not this next leg of the stool will be more traditional businesses that can very simply integrate AI into their business and improve their profitability. I mean, it is that simple. And since this is seen as one of the years where enterprises are going to be embracing AI in a bigger way, you're starting to hear a lot more market pros who are leaning into this potential idea.
Give us some of the potential winners here from this next phase of the AI boom, John.
You know, it's interesting. We've talked to a lot of different investors about it, including Jamie Murray of the Murray Wealth Group, who's been with you this week as well. Here are a few examples of companies, just through the lens of Jamie, that are in different industries but are finding ways to leverage AI. Amazon would be a company that has already benefited from the broader AI trend, and obviously is one of the key players, especially in terms of spending on all the AI chip power that everybody's been talking about. But they've got so many components to their business, including that e-commerce juggernaut arm, which, whether it's the ways they think about distribution through their analytics to the robots that are on their factory floors, in Jamie's opinion, the leverage from AI will help that part of the business. Then you can take the healthcare industry. Last year, one of the big dogs in the market was United Health for a range of reasons. Here is a company, though, in the medical industry that has constantly been cited as one that can very seamlessly integrate AI. And that's exactly what Jamie's view is. If they can work that into the machinery of their business, that's a very easy lift for them to potentially boost their profit. And then there's a story about some of the companies that have been born on the internet or digitally, even in banking. One name he mentioned was New Holdings, which is a Latin American fintech company, which has had a great jumpstart in growing its business very simply because it's online. But then when you add some of these AI tools on the back end into that business, it's his belief that that's the kind of thing that can further turbocharge that business. So there's three different examples of companies, different industries, and I guess, you know, the same way we see the proof in the earnings reports, I would imagine any companies that can convince investors as we go through earnings season that they're able to integrate AI might get more check marks than others.
It's amazing, all right, the effect this is going to have on business. John, thank you very much. And just a reminder to viewers, you can find John's story on our website, bnnbloomberg.ca, and there's a look at it. Also, John, you can check out his work on the Ticker Take YouTube channel. Just ahead, why investors should get used to bouts of volatility in the market. Welcome to the second hour of The Open. Let's check out the big stories we are following in the BNN Bloomberg newsroom. Retail sales across the country came in a bit stronger than expected in November. Data from StatsCan indicates that receipts rose 1.3% month over month, driven by higher sales at food and beverage retailers. And the agency noted that sales were up in 7 provinces, led by Alberta, on higher sales of motor vehicles and parts. In a flash estimate, however, for December, StatsCan says that retail sales probably fell 0.5%. U.S. President Donald Trump has disinvited Prime Minister Mark Carney from the Board of Peace, a U.S.-led effort to oversee the reconstruction of Gaza. Trump made the announcement in a Truth Social post. The withdrawal comes days after Carney delivered a speech at the World Economic Forum warning against coercive tactics by the world's great powers. Another look at shares in Intel as the company struggles to keep up with surging demand from AI data centers. The chipmaker has cited supply chain challenges, along with delays in transitioning to a new semiconductor manufacturing process as the key obstacles in its latest quarter. However, Intel stock jumped about 50% last year, boosted by major investments from SoftBank, Nvidia, and the US government. And here is a look at the TSX. Gold has been moving to new record highs, and of course that has been boosting the market. We're seeing lots of precious metal stocks moving higher. Our index, though, still down from its record high close of 33,090 on Monday of this week. So it's not quite back up to those record highs, but it's been a pretty darn good run. I'm just checking the spot price for gold right now, and we are seeing, 4,950 on the spot price, a new record high. And let's have a look at the US markets, which are mixed. We can see the S&P 500 edging up. Actually, no, I should say they're up broadly. The NASDAQ and the S&P 500 both higher today, slightly. And let's have a look at gold. Gold has had a pretty good session so far, moving above the $61 level. One of the factors there, a weaker US dollar, which automatically tends to help commodity prices when they're denominated in that currency. And sure enough, the US dollar has been down amid unpredictability in the White House. It has marginally slipped today. And there's a look at gold in new record territory, not far off $5,000 US an ounce. And finally, let's have a look at our currency, the loonie. And it is up about 0.25% against the US currency. According to Citi, a broadening is a key theme for the markets in 2026. However, investors can expect ongoing bouts of volatility. Let's get more from Scott Kroner, U.S. equity strategist at Citi. Scott, great to see you. Thanks very much indeed.
Good morning, Andrew. Good to be here.
Now, over the past year, as you know, the Russell 2000, the small cap index, has overtaken the S&P 500 over 5 years. It's still a long way behind. But will that be one of the themes we see, small caps doing well against the big blue chips?
Well, we think so. You mentioned earlier our view towards broadening as we go into 2026. And the way we've been describing it is that there are a couple of ways that you can play this broadening theme. One is by moving away from the mega cap growth tech part of the S&P 500 into other large cap sectors. But another way to do it is by moving down cap into U.S. small mid cap. And so, we've been advocating an incremental allocation to the small cap space over the past several months. And what I would say it's premised on, quite simply, is much more attractive valuation starting point than you get in large cap. Part of that's because it has less of this mega cap growth tech influence to it. But the other part is that if you look at consensus expectations, this year should trigger an acceleration in earnings growth for this part of the market that has been underwhelming over the past 2 to 3 years. So better valuation starting point, improved growth outlook, all to us kind of brings the small cap trade back into focus this year.
What do you think will be the theme for AI investors this year? There was enormous excitement last year. We saw power stocks shooting up. Maybe you could put up Constellation Energy, CEG, without addressing specific stocks here. Will those themes, for example, enthusiasm over electricity build out, repeat themselves?
I think you're right. There are going to be several themes that relate to the AI playbook. The first, we would say it's very hard for the S&P 500 to move materially higher without what we're now referring to as the Elite Eight contributing and participating in that performance. So you need the ongoing spending tailwinds on CapEx and related AI infrastructure to perpetuate here. Another element of this, though, is within this mega cap growth AI effective part of the market, we do continue to look for ongoing points of, let's call it higher dispersion among the stocks themselves. We saw this last year. We think it continues this year. The third element of this is for all of the focus on what we refer to as the AI enablers, those companies that are part of this infrastructure build out and in position then to provide AI-related computing capacity and to other parts of the market. We also expect a shift down the AI adopter path this year, where more and more companies we think will be talking about their own AI initiatives and how that over time should begin to enhance productivity measures and other aspects that potentially support underlying fundamental drivers.
That's interesting. What kind? So we've seen enormous enthusiasm for the enablers, the hyperscalers who provide this gigantic computing power, including Alphabet and Amazon, etc. But you see some industries actually profiting from AI and that attracting the attention of investors?
Yeah, I think when we talk about a structural bull case for the S&P 500 in particular, so moving away from that small cap discussion to larger cap, essentially the bull case in our view is going to be largely around persistence of improving productivity. And what you typically get with improving productivity is at some level, a better margin performance, a better profitability performance. Perhaps it's just more stable earnings because you're better managing your cost structures, right? So the way we're talking about this is going into this year in particular, different from the last 2 years, is that most companies, certainly within the S&P 500, need to have an AI initiative, if you will. If you don't, you probably have investors asking managements why. And if you don't, as a management team, you put yourself at risk competing against other companies that do have this form of AI productivity enhancement approach. So the bottom line here is we think that corporate America is going to continue to push down this direction in terms of how they can incorporate AI techniques and capabilities into their own business models. It's going to be very hard to measure on a one-off company by company basis, but we do think in aggregate, it's going to be an ongoing focus over the next couple of years. And again, it ultimately should come with either more sustainable earnings drivers or with it better productivity measures as well.
And of course, we're all, as investors, everybody's impatient, but new technologies typically take quite a while to actually show up in corporate profitability.
Right. And so that's what we have to allow. So we're saying, hey, look at over the next couple of years. But, we suspect that companies will be talking about it in real time, sort of now, if you will. But in terms of the actual ability to measure the benefits, that's going to take some time. And I think this framework of a couple of years kind of gets the discussion going on that. And like I said, we're going to want specific measures where we can get it, a better margin profile or whatever productivity measure you want to focus on. But I think this is certainly part of the longer term AI playbook. Now, it does come with an offset, the offset being what does it mean for the labor condition if companies can do more with fewer employees? And I think that raises sort of this, push-pull discussion, if you will, between the benefits of AI versus the potential longer-term consequences to, in my case, the U.S. labor base, but you might even, take that more broadly.
We better leave it there. Scott, thank you very much indeed. Scott Cronert, U.S. equity strategist at Citi. We're going to be back right after this short break. Let's have a quick look at AFN on the TSX, and that is Ag Growth, a maker of equipment for the agricultural and food processing industry. An activist investor, Plantro, is pushing for a shakeup there. The company delayed its results, delayed the filing of its results after finding what it thought could be problems with its Brazilian operations, and the CEO stepped down. Now, the company did since issue a news release that reassured some investors that things were okay in Brazil. It wasn't a deep problem. However, Plantro is not happy. It says it holds about 5% of the Canadian grain handling and farm equipment maker, and it has urged directors to reconstitute the board before recruiting a new CEO. The AI boom is everywhere, but skeptics say much of it is illusory, with money flowing between a few players, some of which have yet to turn a profit. If it is a bubble and it pops, the consequences for a lot of people may be dire. This week's Bloomberg Doc dives in.
From Wall Street to rural America, today's AI is the economy, and markets have priced it like a miracle that can't fail.
Investors are really banking on incredible growth. Microsoft, Meta, Alphabet, they are just committing billions and billions of dollars to capital expenditures and expected to continue to, raise those numbers over time.
The AI boom is more than just software, it's construction. So that's building out the data centers, that's securing the energy that's needed, the water that's needed.
But in this burgeoning industry, what goes around doesn't necessarily come around.
A precarious investment strategy is emerging.
Multi-billion-dollar circular deals.
NVIDIA will invest as much as $100 billion in OpenAI.
The merry-go-round of money continues.
Huge sums of money are just being passed between these enormous companies that are pouring hundreds of billions of dollars into the promise of AI.
And the promise is huge.
About 80% of U.S. businesses use AI. So this is a structural shift, like electricity or the internet.
But AI, with all its potential, remains largely unproven for profitability.
Probably the biggest question in San Francisco right now is, are we in an AI bubble? And if we are, then, well, how big is this bubble and how bad would it be if and when it does burst?
So, is this the dawn of a new age of AI-powered growth? Or the biggest bubble ever?
A circular deal is when companies are basically blowing money, products, services in between two of them.
NVIDIA has said it's going to invest up to $100 billion in OpenAI. At the same time, OpenAI is a major customer of NVIDIA's services, of their chips. To make it even more complicated, there are also sort of other middlemen. One example is Oracle. OpenAI sometimes will lease compute from Oracle. And so you have Oracle being a customer of NVIDIA. So you can see how there can be more sort of arrows back and forth between these companies.
But NVIDIA, OpenAI, and Oracle are just part of the web. The full picture entails a who's who of the AI landscape.
This money is kind of spinning around the same companies, and that's why people are worried.
I don't think there's anything inappropriate about that in principle. Now, if you start stacking these where they get to huge amounts of money, then yeah, you can overextend yourself, of course.
It becomes kind of symbiotic, and I think that's sort of the concern that's cropping up now, is if one of those companies stumbles or doesn't do well, does the whole thing fall apart?
A lot of this investment is going straight to the build-out of data centers across the nation.
We're really in an infrastructure build-out arms race.
Have a look at construction spending in 2025. It's down in most sectors, but not data centers or power stations.
We're seeing a lot of companies that are sort of the picks and shovels of the AI industry. They're out there actually, digging into the ground. One recent estimate from Morgan Stanley predicts that companies will spend $3 trillion on AI data centers. That is obviously a major bet.
If you're in the business of selling picks and shovels, you are living it up. You are getting all the money you need, and there's more demand than you can meet.
We're currently in a facility that was once upon a time a textile facility, one of the largest ones on the eastern seaboard, about 1 million square foot.
we realized we could actually repurpose it as a data center.
There is an insatiable demand for building data centers, for making sure that we have the power to build the data centers, the megawatts, the infrastructure, and the expertise. We don't see any slowdown in that for a long while. When it comes to artificial intelligence, time is not your friend. So if you can get up and running in 6 months using a retrofit format versus a greenfield format, which is starting from scratch, which takes up to 2 years, that's a much better proposition.
All these data centers need power. The growth in utility costs is outpacing inflation.
Utility companies have done really well, especially ones that are providing energy to data centers. Construction stocks have done well.
But building fast isn't always built to last.
You don't just build a data center, switch it on, forget about it and make money. You have to keep on investing to keep that technology working. Otherwise, it will quickly become useless to the people you want to sell it to.
And so far, all major AI projects are operating at a loss.
The problem is, every time someone uses ChatGPT, OpenAI likely loses money.
Those OpenAIs and Anthropics of the world are not yet profitable.
Sam Altman says OpenAI should be able to break even around 2029, 2030. Given the amount of cash that company is burning through right now and the amount it still needs to spend to build the data centers and pay for the computing power to do what it wants to do, that feels like a tall order to me.
There's some concern about whether the AI startups are actually able to pay their bills when they're racking up these huge commitments to spending on data center infrastructure.
These AI data center companies, they are the kind of canary in the coal mine. They are the ones where we'll perhaps see on their balance sheet any first sign of companies pulling back from needing as much AI data center capacity.
Right now, all the companies, they're all saying that the demand for AI products is really, really high. If that were to change, if demand were to suddenly weaken, that would become an issue.
To understand the stakes of today's AI boom, you don't need a crystal ball, just a quick trip down memory lane.
You've got mail.
In 2000, the dot-coms promised a brave new world. Instead, we got wiped out savings, empty office parks, and $5 trillion in vanished value.
The worst hit shares around the world have been the technology stocks, including the dot-com companies.
Even the strongest companies in that era took years to recover. Amazon, one of the big, great, famous survivors, its share price didn't recover for another 8 years after the dot-com crash happened. Cisco, one of the picks and shovel companies, it took them 25 years before their stock price recovered.
There are definitely some similarities. One is that there is circular deal making in both instances. The question is this bubble going to get to a level that goes beyond just kind of the normal ups and downs of tech booms, but actually has major consequences for the economy?
The dot-com boom was devastating for the economy, but I don't think it would compare to the far-reaching effects of the AI boom collapsing.
The money pouring in has been a huge contributor of growth to GDP, helping boost a U.S. economy otherwise hampered by tariffs and inflation. Everyday Americans are exposed to this risk via 401ks and other investment accounts that hold stakes in many of the big tech companies participating in the spending spree. So does that mean the AI bubble is too big to pop?
There's definitely this question about, are these companies becoming too big to fail? If they were to go down, that could have not just economic consequences.
There is a suggestion this might be like the global financial crisis, where huge financial institutions needed money to survive to prevent a wider collapse of the economy. Then that's obviously a far greater problem for the US economy.
But despite these stakes, many remain bullish on AI because of the evolving nature of the technology itself.
In the dot-com boom, there were companies that were laying fiber optic cable. Like subsidiaries of a company were basically all spending in a circle, and it did contribute to the dot-com bubble popping.
But after a while, that became the backbone of internet broadband. And that unused part of all the fiber optics that were built in the 90s actually ended up being extremely important for the internet. And so we think with respect to data centers, if there is potential excess capacity that's being built, those data centers will eventually be used.
There's a scenario here where AI takes longer than we think, and therefore the strongest companies, sure, they'll survive. But in the meantime, there might be a huge hit to their valuations.
Ultimately, this technology is not going to burst. There are certain companies that will not make it, but AI itself is not a bubble. There are real products.
It's clearly the biggest gamble that Wall Street has ever made. And this is a street known for its gambling. This is the wager to end them all.
Coming up, the ETF report. We'll be right back. Time for the ETF report. Our guest says as ETFs proliferate and often get more complicated or more aggressive, leveraged, it's important for investors to understand the holdings in the fund before buying in. Let's get more from David Bahnsen, CEO of the Bahnsen Group. David, thanks very much for joining us.
Thanks for having me.
Is there a risk with such a bewildering variety of ETFs and so many? I mean, there are thousands of the things. People are not always clear on what it's holding?
No, they're not clear on what it's holding often, and they're all not clear on what the main objective of the particular ETF may be. So in the simplest forms, just finding passivity and a basic index replication is pretty simple. And then, as you know, it gets far more complicated from there, and having some understanding of what's under the hood is more important than ever.
One fantastically popular product here in Canada is these covered call ETFs, and I think you have them in the States as well. They're designed to improve income from a fund, but in some cases they have underperformed a straightforward ETF holding equities.
They have, and there's a lot of ETFs that have a sort of concept or theme to them, but then the underlying ingredients have more complexity, and so you end up with what would be like a tracking error relative to the performance, and that has to do with the mechanics of how they go about doing these things. They're not so simple, and so it's important for investors to understand how those things work, and then they can understand where there may be a delta between the underlying performance and how their own ETF performs.
Let's get on to one category that you are interested in, and you do offer one in this area. These income ETFs designed to funnel dividends, for example, to the investor. You have one example that you think does a pretty reasonable job, and it's from USCF, and they say, invest in what's real. And this one is the USCF Midstream Energy Income Fund. Why do you think this is something investors should consider taking a look at?
Well, it's interesting that for all the ETFs that we're talking about and how wide the space is, I'm utterly shocked there isn't more competition for active ETFs in the midstream energy space, where you can get the ability to actively manage with Canadian companies, MLPs, American corporate, different categories of oil and gas pipeline type companies at great income, but growth of income, and have it be actively managed. That's what this UMI, the ticker UMI does. And I think that diversification and proactive management has created some phenomenal results.
I'm just looking at some big holdings, pretty recent. Actually, it's a little dated. It's September 30th, but it gives us an idea. Energy Transfer, LP, Enbridge, our own Enbridge, and Williams. So it looks like do some of these LPs pay out income that's more like interest rather than dividends?
No, these are going to largely be pulling through to the underlying investor as qualified dividends for the states, and some of this is of course sheltered. The ETF provides some tax benefit, But again, in the case of that UMI, what you're doing is avoiding a situation where it's all American corporations without MLPs. And then you're also avoiding something that's only MLPs. And that diversification gives a little more bandwidth in the way American ETFs are set up.
Now, you offer one yourself. It's the TBG Dividend Focus ETF. The big part of your philosophy here is don't focus on what the yield is, focus on whether the dividend is growing.
And I think that what I would say is we want to buy companies that at purchase, our blended yield across the portfolio is going to be more than double the S&P 500. But then we're buying the companies because we believe they can grow the dividend and will grow the dividend year after year, no matter what. And we just don't believe that passive ETFs that do that have done it very well. They're subject to an awful lot of dividend cuts over time or very low yield. And so the active approach to dividend growth enables you to get in front of companies that their dividend may be vulnerable as business conditions change. That's what we do with the TBG ETF.
The yield I'm seeing is about 2.5% or maybe 2.6%.
Yeah, but that's a little misleading because in reality, the absolute yield is about 3.7.
Okay.
But with the ETF, the investors at the X date are sharing all the dividends from the quarter before. So TBG has had huge asset growth, and so it ends up having all the dividends collected be shared amongst more shareholders. So you become a victim of your own success. That, of course, is true of all ETFs, just the way they work structurally. But if you were to take the absolute SEC yield and minus fees, it's in the high threes.
I know, and yield is always a complicated subject. And I see it's got assets north of $200 million US. According to my Bloomberg screen. Just finally, I mean, you launched it, I believe, in 2023. And it has underperformed the S&P 500 since then. But of course, it is kind of apples and oranges. The S&P has been driven by companies that pay very low or no dividends.
Well, that's right. And so we've run this dividend strategy for 20 plus years. We run about $9 billion at my firm. And we created the ETF. It just launched in November of 23. And so it's only a little over 2 years old. And of course, in 2024 and 25, you had the AI Mag 7 type trade that did quite well. So we would never benchmark this against something like the S&P. But I will say in 2022, the S&P was down 19%. And our dividend growth strategy was up 5%. So it's a very low beta, and last year was a high beta type year. But yeah, the strategy is going to lean into energy, into defensives, where there's better dividend growth. And that a good dividend growth is certainly not there in the Mag 7. Now, we're only a few weeks into the new year, but you look at year to date, and it's outperforming the S&P by 350 basis points.
No. Yeah, and you see, you're pretty diversified. You got a bit of tobacco, you got retail REITs, integrated oil and gas. You got a very wide spectrum of companies in there. David, thank you very much indeed for joining us.
Thanks for having me.
David Bahnsen, CEO of the Bahnsen Group. Coming up, we'll tell you about these mixed signals coming out of the retail sector of the Canadian economy. We are getting some mixed signals today when it comes to the strength of Canada's retail sector. Let's get more from BNN Bloomberg's Lindsay Biscaya. Lindsay.
Yeah, and the numbers, Andy, show that sales are increasing, or at least they were for the month of November, but just barely, really, when we look at the month of November. A sales increase of 1.3% month over month, so November compared to October. Across the country, 7 provinces saw an increase in sales, Alberta leading those sales, mostly in motor vehicles and parts. And it's interesting when you break down exactly where we saw most of the drive here, which was the food and beverage sector, which for the month of October didn't really see the same sales growth that it saw in November. And when we look at like beer and wine sales specifically, there was an increase of 14.3%. So people seem to be drinking more for the month of November. Gas sales up 2%. And then online sales. This was interesting because when you think of November, this includes Black Friday. Online sales were actually down 2.8%.
They were down.
They were down 2.8%. So a significant amount as well. And we spoke with Randall Bartlett from Desjardins about this today. Just the fact that this is one of the biggest cyber shopping holidays of the year, Black Friday, and you're seeing these numbers down. Here's more on his explanation for it.
November data will pick up Black Friday sales. And so ultimately, we've seen this move toward buy Canadian and away from Canadians purchasing goods from the U.S. And so no doubt this is probably getting picked up in this data. It's kind of tough to tease out what is the different causal factors here, but we've seen that e-commerce has been relatively weak recently. And so I think I think it really is partly a function of this buy Canadian tilt by consumers here in trying to support Canadian businesses that have been hit by the trade war with the U.S.
And we got this flash estimate, early estimate for December, and it did show a decline.
Yeah, so the flash estimate is showing a 0.5% decline for the month of December. So we'll have to wait and see whether those numbers actually parse out to be that way. But I mean, that is interesting. Like, assuming this flash estimate is right, we'll see retail sales slow. And that could show that really for the fourth quarter of 2025, you're seeing a 0.2% decrease overall, which shows that, people were spending less by the end of the year. Way less than they were compared to the beginning of 2025. But when you look at 2025 and you look at everything that happened throughout the year, particularly the middle of the year with the trade war and tariffs, people just are feeling that pinch. They're a little bit more cautious when it comes to spending. And then Bartlett also brought up a good point, is that inflation is still above that 2% target that the Bank of Canada really wants it at. I believe it's at 2.4% for the month of December. So with that in mind, that shows that consumers are still being a little more cautious when it comes to spending. And we could see that reflected in the December numbers.
Lindsay, thanks very much indeed. Lindsay Biscaya. Up next, hot picks. We're going to zero in on the energy sector and some stocks, which our guest says offer strong dividend yield and growth. We'll be right back. Hot picks, we're looking at energy names, but we're keeping the dividend yield in focus. Our guest says this pipeline giant offers a solid yield, but also growth. We're joined by Rob Thummel, Senior Portfolio Manager at Tortoise Capital. Rob, great to see you once again. Start off with Williams Companies, please. I'm not sure if I'm hearing Rob there.
Years, we're kind of we hope we're the energy experts from that perspective. So Williams is a little over 3%, 3 to 4% dividend yield. It's going to grow 3 to 5%. And what it's doing is providing some really innovative solutions as electricity becomes the new oil, and we enter this age of electricity. So what is that? Well, that's providing behind the meter power. So Williams is actually building power generation facilities with contracts with some of these large hyperscalers and these large mega cap techs. And why is that relevant, or why does that matter? It's because that way the retail electricity consumer doesn't have to pay the electricity costs for these big hyperscaler data center parks that are basically popping up all over the world, and really all over the U.S. So we really like Williams from that opportunity. We own it across a lot of our funds, including our Tortoise Energy Infrastructure Fund as well.
Because the consumers apparently in the United States frustrated about rising power bills. I don't think data centers are the only cause, but they are certainly in the spotlight here.
No, you're exactly right. That they are definitely in the spotlight. Electricity rates, as you saw this week from the president, are in the spotlight, and so Williams is providing some innovative solutions to solve that problem and keep electricity prices low in the U.S. for the retail consumer, as well as the commercial consumer as well.
Let's get on to Energy Transfer. This is a master limited partnership. We're looking at a yield of about 7%.
Yeah, no, it's really hard to find high dividend yields, right, in the stock market right now. But Energy Transfer is one place you can go. Tortoise, we've owned Energy Transfer as one of our top holdings across our energy infrastructure products for a long time. It's currently one of our largest holdings in our Tortoise Energy Fund, and we really like Energy Transfer for its yield. But we also like it for its growth. It's going to grow 3 to 5%. But more importantly, we like it for its diverse set of energy infrastructure assets. And not just that, these are hard to replicate assets. You can't replace these assets. So there's a scarcity value in the existing assets that Energy Transfer owns. And so we think that the stock offers investors a really nice dividend yield, some growth, but still is really underappreciated and undervalued. And so it offers some total return from a capital appreciation perspective as well.
And finally, Cheniere Energy, LNG, no doubt from the stock symbol what they're all about, a huge player in exports of gas.
Yeah, so what we like about Cheniere, and it's been one of our top holdings as well at Tortoise for a while across our energy infrastructure products, is this. We like Cheniere because it is, as you highlighted, the largest exporter of liquefied natural gas in the U.S. But we also like Cheniere for a lot of the reasons why we like a lot of energy stocks at Tortoise. It has a lot of free cash flow. It has a high free cash flow yield. And then the management team at Cheniere has been very disciplined and really excellent allocators of capital. So they're increasing their free cash flow per share.
I do hear the audio deteriorating.
But what they're doing is they're buying back stock with that.
I think we might have to say goodbye to Rob there. Our apologies to him and to you watching. We just had an audio glitch there. That was Rob Thummel, Senior Portfolio Manager at Tortoise Capital. We always like hearing from him. Coming up, the President of the European Central Bank says she doesn't agree with the Prime Minister, that the world order is rupturing. We'll get more after the break. There was massive coverage of the Prime Minister's Davos speech in which he talked about a rupture in the world order. It made headlines around the world. However, some world leaders are starting to push back against his view of a disintegrating world. For example, European Central Bank President Christine Lagarde says she's, quote, not exactly on the same page as Carney. Let's get more from Paul Sampson, President of the Centre for International Governance Innovation. Paul, thanks very much indeed. The tone of Mr. Carney's speech was striking. He talked about hegemons, aka big world powers, pushing other nations around. It sounds like some world leaders think he may have gone a little far.
It was a detailed speech and it was very direct. But I think what took us to this point was, you know, America first has some sense, others should do more. But then there were aggressive tariffs, there was the takeover of Venezuela, and then above all, Greenland annexation in any means possible, right? And I think that was the tipping point that actually created a rupture, which I think is true as opposed to a transition.
Sorry, give us that point again. Where is the key point of contention here?
Well, I think the America First has gone too far in its aggressiveness, right? I mean, the idea of annexing a state within the NATO alliance, within your closest partnership, by any means necessary, is actually a rupture, right? That's not a transition. A transition is new technologies and things like that, and emerging economies, and that's been going on for the last decade or so. But the rupture arrived.
But to say that we're just into a new era for the world, some people find that's going a bit far.
Yeah, I mean, I think that you get the reaction of Christine Lagarde and others. They're incrementalists by the definition of their job. The status quo, they need some status quo to keep chipping away at their mandates, right? Like a rupture is a problem for them. If there are new regimes that emerge, like plurilateral ones, like a trading regime in Asia Pacific that doesn't include the US and China, that's a very different kind of regime, right? You know, she's heading up the ECB, but she's still wearing her IMF hat a little bit, I think, on this. And I think she's yeah, she just wants to go slow and she wants a transition. But I think it's more than that. Many leaders have come out and said they agree with Carney's speech. Mexico, Finland, Australia, they're kind of saying, yeah, this is what's happened.
I'm looking at a headline here in The Guardian of England, which, of course, would be no fan of President Trump. Mark Carney is emerging as the unflinching realist ready to tackle Trump. So he really put himself on the world stage there.
He did. I mean, he is a realist. I think that between Canada and the U.S., it's a spat, right? It's a phase. It's a tough one. But in the end, they're going to get along, right? This huge border with the integration, like that's not going to go away. But there's a spat going on big time. And now it's global, right? Because this is... It's affecting every country. There's no country that's not pulled into this right now.
I mean, for a long time, America avoided actually having colonial possessions. It preferred to, well, dominate countries, let's put it that way, if you want to put it that way, or to exercise its power through trade and technology transfers, etc. But this grasping for territory, or apparent grasping for territory by the president, it looks like a new thing.
Yeah, I think that was the tipping point, right? It didn't really make sense because the U.S. has a base on Greenland, a major military base, so they kind of have access now. You've got to think this was about controlling critical minerals in the future and shipping lanes through the Northwest Passage and that kind of thing. Why they wanted more, because they kind of have it now, and it does cross the line, right? And I think that's why you're seeing the reaction. There's also just an opportunity for middle powers to assert some collective power here, right? Like, you know, they don't want to get pushed around by the biggest players.
I suppose some people might say, well, Christine Lagarde, she's the voice of the establishment. The current system has suited her very well. Do we need people with a bolder vision, perhaps, such as Mr. Carney, to weigh in here?
I would say yes, because it's that much change has gone on. I mean, I think Christine Lagarde is very competent in many ways of her job, but she does represent the old guard. It sounds a little ironic, but you know, she's definitely an incrementalist and sees it as, you know, we're on the right plane. Let's just make some adjustments. I think the world has changed more than that, and most countries see it that way.
Lagarde says, sure, trade has suffered the biggest disruption in 80 years, but I think the system has been put together in such a way that it's quite strong and it will take a lot to destroy. Well, she may have a point there.
Yeah, it's a great system. It's delivered a lot of things. It hasn't delivered on equality enough, right? Within countries, the gap has been growing. Between countries, it's still too big. So the system hasn't fully delivered, which is part of the backlash in the U.S. Too much globalization. They're totally right in the U.S. They needed to dial that back a little bit. Other countries needed to do more. It's not an outrageous. Parts of America First are legitimate, but not the excessive parts, right? Including aggressive tariffs and certainly land grabs.
Yeah, we're putting up a board from El País of Spain. Carney leads the moral and geopolitical opposition to Trumpism in Davos. And that's the quality Spanish paper. So. Right. I mean, the speech really struck me as being pretty extraordinary for a Canadian leader to make.
Yeah, some people have called it the biggest speech ever at Davos. You know, there was a standing ovation on site. Like there were people found things they liked in there. There are some things to not like, for sure, from the U.S. side. I'm not sure they're going to take it at every word. Ultimately, what's going to matter here is action, and Canada and other countries are going to have to really step up, facilitate new conversations, new ideas. This doesn't just happen on its own.
We'll have to leave it there. Paul, thank you very much for joining us at short notice today.
Thank you. Great to see you.
Paul Sampson, president of the Centre for International Governance Innovation. We're wrapping up the Open. Morning Markets is up next.